Credit cards. So many of us have them, right? But here's the big question. Are they a smart financial tool or just a trap waiting to spring? Welcome to The Explainer, where today we're going to break down exactly how they work so you can finally make them work for you.
So let's just jump right in. Is it a tool or a trap? Well, the truth is, it can be both. It completely depends on how you play the game. And stick with me, because by the end of this, you're going to have the complete playbook to make sure that little piece of plastic is your ally, not your enemy. All right, here's what we're going to cover. First, we'll get the basics down, your money versus the bank's. Then, we'll look at the two-sided nature of these cards. We'll even pull back the curtain on how banks actually turn a profit. And finally, we'll get into the real strategy, how to win the billing game, and the one rule you absolutely need to know. Okay, section 1. Let's start with something that trips a lot of people up, but it's super important. The real difference between the two main cards you've probably got in your wallet right now. It really is this simple. With your debit card, you're spending your own cash straight from your bank account. No more money in the account? Well, you can't spend anymore. But a credit card, that's you borrowing money from the bank. It's a short-term loan for every single purchase. And believe me, that one little difference, it changes the entire game.
All right, on to part 2. This is where it gets really interesting. Because that same piece of plastic, it can be your best friend or it can be your worst enemy. And what decides which one it's going to be? It all boils down to one simple thing, whether or not you pay it back on time.
Let's talk about the friend side first. Think about it. Let's say you spend a lot on stuff you were going to buy anyway. Groceries, fuel, you name it. If your card has 5% cash back, you just earned 5,000 rupees for free. You used the bank's money, got rewarded, and then paid it all back before they could charge you a single rupee in interest. That's a huge win. But here's the scary part, the faux side. If you don't pay that bill in full, you get hit with some absolutely brutal interest charges. We're talking, what, 3 to 4% a month? That might not sound like a lot, but it adds up to a crazy annual rate, sometimes close to 48%. And that right there is how a tiny bit of debt can explode into a massive problem.
And this leads us to what is honestly the most dangerous trap the banks sent. They send you that bill, and right there in big, friendly letters it says, just pay the minimum amount due. It's usually just 5% of your total bill. And sure, paying it might keep your credit score from tanking right away, but what about the other 95%? Well, that's now getting hit with that sky-high interest rate. It's literally a recipe for getting stuck in debt forever.
So you might be thinking, hold on, if they're giving me cash back, rewards, all this free credit, how on earth are the banks making money? Oh, don't you worry, they have a very, very profitable playbook. They basically have 3 ways to get paid. First, you've got your basic fees, like a joining fee or an annual fee. Simple enough. Second, there's a fee they charge the shopkeeper every single time you swipe your card. But the real jackpot for them, the absolute gold mine, it's the interest and penalties from people who don't pay their bill in full. Yeah, let's zoom in on that second one for a second. The fee to the shop. It's called the merchant discount rate, or MDR. So when you make a big purchase, the shop doesn't actually get all your money. The bank takes a little slice, maybe 2 or 3%. This is exactly why some smaller shops might ask you to pay with cash. They're just trying to hang on to that extra couple of percent.
Okay, so now you know their playbook, let's talk about how to write our own. We can totally use their system to our advantage. And the secret weapon here is understanding the billing cycle.
Want to know how to get almost 2 months of interest-free credit? It's all about timing. Let's say your statement comes out on the 30th of the month. If you make a big purchase on day 1, the first of the month, you get that whole 30-day cycle, plus another 15 to 20 days after the statement is generated to pay it off. That's how you get that maximum 45 or 50-day free loan period.
But look at the flip side. If you buy something on the 29th, just before the statement date, bam, the statement is generated the next day and you only have about 20 days to pay. The takeaway here is huge. Find out your statement date. Seriously, knowing that one date is the key to playing this game like a pro.
Okay, last section. And this is probably the single most important rule for keeping your credit score healthy. And trust me, you'll want a healthy score when it's time to get a loan for a car or a house down the road.
It all comes down to something called your credit utilization ratio, or CUR. Sounds complicated, but it's not. It's just the percentage of your total credit limit that you're using. So if your limit is 1 lakh and you've spent 30,000, your CUR is 30%. It's a simple number, but it tells lenders a whole lot about how much you rely on borrowed money.
So here's how lenders see it. If your utilization is low, say under 30%, they think, okay, this person is responsible. But if you're constantly maxing out your card, using 90% or more, that's a major red flag for them. You might be thinking, but I pay it off every month. It doesn't matter. To them, it looks like you have no financial safety net, like you're living right on the edge. And that kind of financial stress can really drag your score down.
So let's wrap all this up into 4 simple golden rules. Your new playbook. Rule number 1, always, and I mean always, pay your entire bill in full. Don't even think about that minimum payment trap. Rule 2, keep your usage below that 30% mark to keep your score looking great. 3, you don't need a wallet full of cards. Just 2 or 3 really good ones is all it takes. And finally, Rule 4, be smart about it. Use your fuel card for fuel, your online shopping card for online shopping. Maximize those rewards. You see, when you follow these rules, the entire dynamic shifts. That credit card stops being a potential enemy and becomes an incredibly powerful friend in your financial toolkit. The game is laid out, the rules are clear. Now, the choice is all yours. Thanks for joining me on The Explainer.